Welcome, everybody. This is our fourth quarter review, preparing for the fourth quarter. You know, I'm laughing because, man, I'll tell you what, this has been an interesting market, and it certainly has been an interesting year, especially how different markets have traded. We've got really formidable types of actions, which we're going to get into, and I think a lot of people have been looking at seasonality, and while we do have some seasonalities that may exist in the marketplace, there are some certain rules that we want to observe that supersede seasonal trends. So this is not a seasonal trend overview, even though we will have some. But before we begin everything, may I be at least the first to mention, we need to keep in mind that trading involves risk of loss. And so let's just get the formalities through with this risk disclosure statement. If you could just give a second here of reading this, it'd be great. Wonderful. A couple of questions in the audience. Someone that had, I think it was, we had a question, will I be in Las Vegas? I'll be in Las Vegas for a small stint, a very small, a flyby. And a flyby means we'll be zipping in and zipping out. I'm doing one small presentation, and hopefully we've got some business meetings lined up on the side. So I don't know if I'll be at the Traders Expo this year in full force like I have in years past. So we're going out there for dual purposes. Bottom line, this year we've had some really neat developments, and I'm going to get all our announcements out of the way so we can move forward. What's new at Person's Planet? Many of you who are using Thinkorswim know about the launch of the PMC indicator, which has given some really amazing, I would say, heads up and insights in market conditions. We'll review that in just a little bit. TradeStation, we did our trilogy buy and sell scans and radar screen. We launched finally the Person Algo 17 Extreme, which was, we haven't really gone into that as much, but for all of the folks that had purchased the Person Algo Optimizer, they got this, and we'll talk just slightly a little bit about that today. Seasonal commodity spreads were available, files updated for all of Trade Navigator, and then finally, probably the biggest announcements was the expansion of Person's Planet, was the launch of J-Person Asset Management. That was, not to confuse people that, hey, we're going to stop everything. No, it was, we were expanding business into money management, something that has been on our plans for years. We had several things that we were doing, developing systems, developing strategies. And kind of funny how everything comes to fruition. Part of mostly this was the reason how we created that. Isn't that something? So the two are very much tied in of what we've got going on. And I think that as 2018 comes to a close, it's so funny we say that. 2018 comes to a close. It seems we just started 2018. How about it, folks? We were just on a cruise to the Greek islands, and that's come and gone. This year, we got a brand new puppy here. So Person's Planet's had a lot of new developments in 2018, and that's why we're here together to look at how are we closing the year out. So a very interesting year. First, let's just cut right to the chase. What are our fourth quarter trends, and why has it been so much so that Q4, we generally see the October bear killer month that it's called, because under normal years, and again, let's face it, this has not been a normal year by any stretch of the imagination. Not back-to-back performances like we've had with equity valuation. And, of course, the overall sector rotational grind and passive, the debate between passive and active investing. Passive meaning you buy ETF funds, and active meaning you're a stock picker kind of thing, right? But we tend to see in the fourth quarter, we tend to see more volume in trading. People are back from vacation. Fiscal year ends. The government's back to work supposedly, or in unison. That's another debate for another time. But broker-dealers tend to trade higher into the fourth quarter or in the fourth quarter. And it has not been the case for many broker-dealers. And when I say broker-dealers, we also need to also include exchanges, because the XBD years past, remember, exchanges were not added to that. All the exchanges kind of went public in the last 5 to 10 years, right? So ICE, the Intercontinental Commodity Exchange, NDAQ, CME Group, those are all added into what we would consider broker-dealers. The traditional broker-dealers would have been Charles Schwab, now Ameritrade, TD Ameritrade, AMTD is the stock symbol. We'll look at that. E-Trade. So there's a lot of different broker-dealers. Benjamin Franklin, Asset Management, T. Rowe Price, they're all in that mix as well. So we'll examine some of those, because as I was starting off with our presentation, seasonality gives us a guide of what the trends of supply and demand on fundamentals have been in the past. It's not necessarily indicative that past performance will repeat itself, but it sure sometimes mirrors itself. And, you know, some years, as my famous phrase is, some years you have a muted reaction, some years you have a magnified reaction. I'm not sure how we're going to get a reaction this year in some of these sectors, but telecoms tend to trend higher, and the telecoms has generally been AT&T and Verizon, but we've got T-Mobile. You have in that telecom space, you have American Tower, Cellular Phone, Crown Castle International, CCI. There's other different aspects of the telecoms, and that sector ETF is IYZ. So you'll notice here, I've given just an outline of what happens in the fourth quarter and the symbols for those sector ETFs. Ironically, bonds tend to trend higher in the fourth quarter. Maybe that's because we tend to see people address portfolios and tend to, after the third quarter, people are looking at, people get older. There's, as I said, fiscal year end. There's all different kind of forces that come into the fact that people may want to be buyer of bonds, not a seller of bonds. So this year is going to be maybe a little bit different because why? The Federal Reserve and central bankers. It was just announced that the European Central Bank is going to scale back their bond buying, which was a version of their quantitative easing, and that's very important. So different years have different structural trends that can alter those seasonal tendencies, but we want to pay attention to the TLT, and if bonds go up, a sister market is utilities, because why? A lot of utilities companies, they do what? They issue bonds. So I'm trying to draw an arrow and it's not very good, so I'll just stop with the drawing tool. Materials, XLB, not because of gold and silver, but also just materials sector tends to move higher. Industrials tend to trend higher. Healthcare trends higher, XLV. Not so much drug and biotech, but healthcare. So that would be your healthcare facilities. Your insurance would be in that. So your Cardinal Health, your Tenet Healthcare, and now maybe perhaps you get more people as with an aged society. We start to see more people moving in assisted living facilities, and so that's an added function of XLV. Consumer staples tend to trend higher in the fourth quarter, or at least after long-term declines from the third quarter, then we see recoveries into the fourth quarter. These are all very strong. These are actually the strongest trending sectors that we have going from early October into mid to late December, by the way. These were the strongest trending markets. Now, others tend to move sideways. They go up a little bit, down a little bit. But here's a fourth quarter trend for you. Crude oil tends to trend lower in the fourth quarter. Hurricane season's over. So threats to our refiners have diminished. We tend to see less driving, right? So we tend to use and consume less fossil fuel. Diesel fuel transportation is maybe sporadic. People don't travel as much like they would in the summer, for example. You do get that occasional bump due to the holidays, Thanksgiving, Christmas, that type of thing. but in the fourth quarter, we tend to buckle down, hunker down, and we start to see crude oil trending lower. That doesn't seem to be the case now as crude oil is pressing $75 a barrel because we have what? A mitigating fundamental situation with sanctions against Iran. So a tightening oil or a potential tightening of supply is something that is looming right now. So again, these fundamental events outweigh the historic seasonal tendency of the market. But my job right now is to walk through what are the trends to spot for this year, how will it affect the overall market. But one of the big ones that I think is just blaring here is retail. XRT tends to move lower. A lot of people think it goes up because of the holiday spending. It's kind of funny. It doesn't. More times than not, you don't see the retail until after Q1 when we get into that earnings season and we find out who did well on Black Friday, for example. What is consumers' buying habits? Are they buying more appliances? Are they buying more electronics, large screen TVs? Are they getting rid of their 65-inch 4D TVs for the 70-inch? I doubt it, but that we'll see the consumer trends moving forward. Besides Apple, iPhones, and iWatches, what else is there out there besides clothes, shoes, and electronics? And of course, I think there's a lot of trend of people right now doing more outside activities. Camping, for example, hiking, for example, things of that nature seems to be a consumer trend right now. And that's not enough really to spark a retail trend of pricing a lot higher right now. So this one we're going to cover just a little bit today because that is more of a, I think more people have asked me in past years, hey, why isn't the retail stocks moving up? And it's because they definitely have a seasonal tendency to move lower. Home builders trend lower. It's kind of hard to sell and build a home in the wintertime. People are more focused on what? The holidays, right? Biotech, pharma. This is the one that is mostly mixed. It doesn't really have a strong uptrend or a downtrend. So as we get into the fourth quarter, I wanted to get into, of course, some of the historic seasonal trends that are more reliable that I think will still maintain its structure. In other words, for example, crude oil, I think it'll maintain its structure of moving lower because this rally that we see up at 75, at least what we discussed in our live trading room community today, is the crude oil market, as strong as it is, and I get that, we're starting to see kind of a weakening function with the open interest. And that to me is a very interesting tool to use when it regards to commodities, because a strong uptrend you would see corresponding increase in open interest net long positions. So I wanted to we'll go over that. And then finally, the fourth quarter, and this is a midterm election year, so we're just going to put here, and we're going to talk about VOTE, vote, right? So we have midterm elections. And my philosophy or my thinking right now is that we've gone through the Federal Reserve last week, which raised rates a quarter point. Pretty much everyone anticipated that. Jerome Powell, the new chairman of the Federal Reserve, made mention, friends, that, hey, you know what, the Fed's kind of worried about potential ramification of trade wars and how that would slow GDP. And that was a concern. Well, we just got some really strong economic numbers that didn't seem to slow down GDP. And this Friday, we have the unemployment report. So we'll be taking a look at a couple things. The headline number, but more importantly, it'll be the average hourly work week, if that upticks, and wages. If wage cost pressures increase, that's inflationary, and that may tip the Fed to be more aggressive in 2019 instead of a quarter point hike, a half point hike, and nobody's talking about it. But right now, the market is set to have a more aggressive Federal Reserve tightening cycle in 19 than not, because we're starting to see global economic conditions unwind and see better performance. And with the European Central Bank curtailing their quantitative easing, it makes it a little bit easier for the Fed to react a little stronger than what's built into the market possibly. This thing that I just wrote about vote, that is probably the first and foremost of anything on most investment and corporate decisions right now. And one of the main reasons is the rally, and let's not fool each other, the rally was specifically based this year and last on a Republican win. And the dynamic shifts in philosophy, such as relaxation of over-regulation, curtailing some of those excessive rules, right? And allowing companies to flourish a little bit better. Of course, tax cuts really kicked into high gear, and that gave us an extra boost in the market. With the Republican sweep or Republican control in both the House and the Senate, it helps give people the confidence that the White House agenda will continue its course, and that would be more positive for the market. With Democrats taking over and replacing some Republican seats, that, my friends, is something that would maybe be a kind of a stone in your shoe, so to speak, and slow things down a bit. So this thing, vote, the November midterm elections, is probably the real deal in the marketplace that we have to look forward to. Last week, I was in Spain, and I was in the southern area. They call it the Gold Coast near Mallorca. Not Mallorca, Marbella, excuse me, Marbella. If you've ever heard of the Rock of Gibraltar, it was, I don't know, 20 kilometers from Gibraltar, which was, we did go and see. The most fascinating aspect there was the billboard signs of timeshare, timeshare, timeshare. I lost count at 70, 80, somewhere near 78 or 80 scaffolding, these large scaffolding, building major buildings. The construction that's going on is insane. The homes that are there are insane. It does attract, by the way, that area of Spain is a large attraction for British citizens who want a vacation. It's kind of like the Palm Beach for UK citizens, so to speak. Why do I bring that up to you? Because the construction in the building and the ease of getting bank loans was crazy. If you recall, Spain and Portugal had a major housing crisis that, you know, it was like that contagion issue. And it seems that they have completely shrugged that off. Lots of building going on. So these are not inexpensive homes or inexpensive buildings that are going up by any stretch of the imagination. So the wealth effect around the world, if you think that things are slow and economies aren't growing, it was just absolutely mind-boggling to see that there. So my observation is that there's room for tightening in not just rates here, but also abroad. And so that's one of the things that we have to kind of consider. Now, we've seen a lot of changes this year. In the last few years, and many of you have heard this before, but what, where, and when we trade has changed dramatically. What is going to happen into this fourth quarter? You know, in this year alone, and I'd say 11 months, and I'm just going to stick to the next slide, because what's really changed is we've seen a come and go. Remember, XIV was an inverse ETF. In February, said goodbye to that as it defunct. It traded one day at 111, and the next day it opened at 1181. That was from $111. The next tick, the next day, was $100 down, and then it delisted. So volatility products, and then because of that, they changed the structural valuation of the VXX, which is a product that we're very fond of trading. And how did they change it? They changed it in the valuation of, instead of the two front contract months of the VIX futures, it's now the month and a half. So it kind of lost a little bit of contango crush, but it has changed. In other words, we get products and then they change the structure of them as conditions in the markets have changed. Remember, February, we had one whale of a little mini correction in the market, and a lot of traders were all flocked into volatility products. A lot of people got hurt on that trade. Cryptocurrency, Bitcoin, boy, that was the rage just 11 months ago. I'm not sure if I want to accurately quote this, but if I'm not mistaken, I believe Bitcoin, I don't know if many people still follow Bitcoin or if you follow other, what is it, other electronic currencies. I guess that's what I'm trying to say. But I believe Bitcoin is, if I'm not mistaken, at least the ETF, the over-the-counter GBTC is trading and scraping near its lows. Bitcoin itself trading near 6,500 is, it's just sitting there holding value. This summer, many people were, and I know there's a lot of people that are still hanging on to their trades or at least their Bitcoin, but it seems to have lost its popular edge right now. You don't hear as much about it. So, I mean, that's kind of come and gone. The big thing is, and has been big in recent months, has been pot stocks. INSEE is one, Aurora Cannabis is another, and there's lots of other stock indices. I address this right now because today we had a new low in the Russell, back to trading to the end of January areas. Momentum stocks have changed. Look at FANG stocks, Facebook, Amazon today did generate a daily low close doji, weakening volume, weakening relative strength, as we would see in regards to the person's market catcher. So we're going to cover a couple of those. Foreign stocks don't seem to be as popular. We've got ETNs, ETFs, leveraged inverse, then commodities. Forex isn't as popular as it once was. There's no volatility, even with a increase in interest rates here versus abroad. And again, options trading. Options. That it's kind of interesting how times kind of change. What's happened in the world of options? Many of you may or may not agree with the slide that I'll share with you in a few minutes. But out of all these changes, gang, a couple things that we have to look at is PPS buy signals, candle patterns, my person's pivots, our relative strength for stocks, last conditional changes, and again, money management. These are things that, and again, my top, I would have to say, if you said, John, out of your top 12 methodology things that you use, what do you need to rely on the most? And I would say, obviously, I would go with number one, PPS. Number two, it's a candle pattern, so it's very close to price action. Number three is person's pivots. Number four, I would say definitely volume. Number five for stocks, my person's market catcher. Number six for stock indices, advanced decline or breadth analysis. Last conditional change is a price action pattern, so that would probably go in that category. And then finally, money management. Being able to decide how much to allocate to a trade. If a trade signal is strong, or if we come late to the trend, instead of devoting 100% of your equity to a trade, if you're late to the trade, maybe go 30%. So you need to adjust your portfolio or your position sizing to adjust for if you missed a trade signal. Money management is in position sizing is excruciatingly important. So out of all of this, and this is why I did a quick test, I want to go over a couple things briefly with you guys. First and foremost, there's approximately a 7-second delay here when we start bouncing things around. So I don't want to bounce too much around. This is a psychedelic, squirrely market environment to biblical proportions. One of the weirdest things I've ever seen all year, by the way. And I know many of you have come to my presentations this year, and I know a lot of them are recorded. And I know earlier this year we were hell-bent on being long the Russell. I know that we were looking for the Russell to outperform the S&Ps. And then we got off the Russell, and we were looking for the S&Ps to outperform the S&Ps to outperform the Russell. Most of that was 100% accurate. And some of the tools that helped me was, again, the advanced decline analysis or breadth analysis. And I want you to look at this because this is a part of the person's lifetime package with TradeStation. This is the S&P 500 on your upper left. This is the NASDAQ 100 in the middle. And this is the Dow Jones Industrial Average. Everyone was making a hip, hip, hooray that the Dow made a new high today. and that's wonderful. It's interesting because the advanced decline did break out on the Dow. That's 30 whole stocks. And it did have some decent volume because the on-balance volume broke out, confirming this. What's very interesting is notice that the gap from Monday still exists. We have a gap in the market. What is a gap? A gap is simply a price that has a high of one day and the low the next day leaves a space on the charts. So there leaves a higher high. And usually speaking, when you get a gap in a market, it's generally filled. It's called unfinished business. Now there's some unfinished. Here's a gap here, and it took a while, but it came back and filled the gap. So the odds are that we are going to come back and fill that gap. So we're looking for maybe some relative weakness for a gap filling in the next, probably, if I had to say, when sometime this week within the next 72 hours, probably by Wednesday or Thursday ahead of the unemployment report. So why did I say this is a squirrely market, and why did I say something's the weirdest I've seen all year? Because the advanced decline, and I want to share this with you because I think it's very important. The advanced decline on the New York Stock Exchange has broken down not just for a couple days, but literally the trend and the severity of the trend is taking time, and it's taken its toll. So time and duration and the action that we've seen, meaning lower lows, lower high, and the deterioration of the advanced decline puts us back to when prices were about right here with the NYSE. So that's number one. Number two, the NASDAQ composite, same thing. Look at the amount of time that it has spent trending lower. And I'm not talking a couple days. I'm talking over a month of making lower lows and lower highs. And today we did the same thing. We came back to where we were here when prices were a lot further than where they are at current levels. Finally, the Russell. The Russell, the IWM, is trading right back to where we were at the end of July, early August, and the advanced decline broke that level, by the way. So we are now in a breakdown. It's the severity of the breakdown of the advanced decline. It's also the third of the bottom of my top 6 stock indices. 1, 2, and 3 have broken down, and they're all synonymous. So that leaves the Qs, and the world runs on Apple and Amazon, but it ain't running on Facebook right now. And again, Netflix, and we won't talk about Tesla. But the market here and the structural change that's going on in the market, I've not seen this, gang. I have not seen this all year. Most of these stock indices have all been trending. Forget the prices. I'm talking about the breadth of the market. The breadth of the market has been trending up in most of the stock indices at the same time. As you can see here from August, we had a nice run up in the NASDAQ, and in August on the Qs, let me bring this to focus for you. You'll see what I'm referencing. It was trading, it was in sync, it was in correlation, they were jiving together, they were gelling. We had a nice uptrend in the advanced decline, a nice uptrend in the advanced decline, and something has it's decoupled. And that is a worrisome. So if someone said, John, you've kind of been a cautious bull all year. You haven't really put many sell signals out in your thoughts and observations. In fact, if you look at, and I'll share this with you, for a weekly thoughts and observations, good, bad, or indifferent. What I wanted to share with you, I'll just show this little Excel spreadsheet. This isn't a part of the presentation, but I just thought I'd just give you as an example, testifiable example of, look at the difference of the amount of trades this year in stocks only, on long stocks only, and then versus short. I mean, a bear ETF SFO once this year. It didn't work out back in July. Seagate Technologies, Intuit, Apple, and MasterCard. So looking at the percent of cumulative, we've been pushing out more long stocks and in the marketplace than anything, right? So it hasn't really given us a lot of sell signals. That's what I wanted to bring to your attention. Why would that be? Well, because the advanced decline and the cumulative breadth and volume analysis suggests to be on the long side of the market. Right now, friends, this is a bizarre, and it not just was today, but on Monday, if you attended my morning market briefing on Monday, it's a dual broadcast between our own trading community and TradeStation. I said, you know, we have a sell signal in the Russell, and again, I said if we close greater than the last additional change or that high in the market, if we can get a cumulative uptick in the breadth, then I want to be a buyer on strength. And again, the market, if you think about this, in 2 days, I mean, just crushed people. This is generally speaking, it wasn't just the decline in price as much as it's the amount of stocks, the advanced decline cumulative line that broke down. That's not positive, but also look at the cumulative breakdown that occurred here and the cumulative breakdown that occurred there. So from a testifiable evidence, looking at the breadth of the market advanced decline, if you combine all of this, and I'm sure people can come to reason and say, well, John, because of this and because of that, but, you know, gang, all year long, most of the market has been in sync with positive advanced decline work. So while they've all gone up, they've been in sync. Now there's a decoupling. So that is a exclamation point, and an exclamation point again to say something is different in the market. So that's number one. So I think from a seasonal perspective, I first and foremost wanted to bring that to your attention because things could change dramatically in the marketplace. This has been one of my, probably when I get into the person's methodology and when I say what's changed, that's the first thing that comes to my mind, guys. All right? That's the first thing that comes to my mind. What's changed right now? So out of my person's methodology, breadth analysis for stock indices. That's kind of helped us to say, where should we be? And then looking at that, I think it's an interesting concept about volatility. And I often talk about the VXX. And introducing VXX, it's kind of a program and a product that takes trades against volatility in the marketplace on the SPY, the S&P 500. Now, I'm going to go back to TradeStation. This is a kind of an interesting concept here using our algo optimizer product. So give this a second. It should bounce back into focus. There's about a 7-second delay. Now, this is an interesting, an amazing program that we've put together, that we've created here at Person's Planet. First and foremost, these are different algo strategies. Some you guys have in your hand. When you get the algo optimizer, we created strategies for you, and others are proprietary. Now, what I wanted to point out is it's interesting that this product makes more money on the short side than it does on the long side. But over the last couple days, the volatility index, the VXX, look at this. It's long on this model. 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 And I'm just double checking if there's sound in the room. Double check if there's sound in the room. Testing. We got a Y, so we have sound here. Okay, cool. All right, just wanted to make sure there was sound in the room. I didn't want to lose it. And so this is one model that we look as a test. It went short. This is one that generated a short trade in the last hour. Double checking, do we have image? Are you guys have image? Because it's kind of hard if you can hear me but can't see things. That would be a problem. All right, double Y, we do have image and we do have sound. Excellent, thanks guys. And then this model here is completely flat. Didn't take a short, didn't take a long. All year long, let me tell you something that's very interesting. All year long, every single one of these models, except for long only, because these are not long models. Every single one of these have been in sync this year. all week long, none of these have been in sync. They've either been long, they've been short, they've been giving different signals in the volatility of the VXX. Here's one thing that we covered in the live trading room, and I'm going to go over this one with you guys real quick. What I find interesting in the marketplace at this point in time is that after big time trends in the market, we go through a period of consolidation or what I call, maybe adjustment period before we reset. Now, one thing that I do not like about the volatility index at this point is that while the S&P's made a newer high on the year, everyone knows that, this product did not make a new low on the year. That's number one. And number two, you can clearly see what I've already outlined. We have a market that has made subsequent newer lows in the market with higher volume readings, both in my proprietary volume indicator, which is on the person's lifetime. PUG members have that. And then on balance volume. So we've made a distinct new lower low, but there's no follow through in volume on this market. This leads us to believe it is in a questionable condition, and therefore the market, at least according to the S&Ps, is giving mixed signals. So when we're looking to trade, we want to look for a methodology or a system, or at least something that's going to say, hey gang, is the stock market getting ready for a new leg up, or are things coming to an adjustment period? And I think between looking at the volatility models that we have, all being in different long, short, not in, quite frankly, here's a complete opposite. It's short in this model, and it's flat in this model, and it's flat in this model, and it's long in that model. So you can clearly see what I'm referring to. They're not in sync. Even our algo system strategies are not in sync. So the more systems that you say, hey, what does this model look like? What is that model? When all the models are in unison, you go with the trade. And when you dig down a little deeper, if looking at the market, if the algos are confused, can you imagine this is what's bringing confusion to the marketplace right now? So how do you trade when the market, and I think many of you guys, are probably, a lot of you guys are option strategists, and you're looking at volatility and different ways of measuring a market. And we've seen unprecedented volatility and weirdness in the way the market's traded, because it really is on pins and needles. Everyone's really quick to run to the exit door. They want to be long, but they want to be quick to the exit door. But if I had to raise a caution flag for the first time since 2016, when I was extremely bullish the market, and you guys know this, you've been around long enough, I would have to say this is something that if you think the market's easy to trade, then sign off right now. God bless you. Is the market complicated? I'm not saying it's complicated. Larry B says he really tries to make it look complicated. Larry, I'm looking at facts. I don't like to give an opinion. I like to look at facts. And I look at the overall facts, because when I get my opinion into the market, it kind of tends to get me lost. And it's not really complicated to look at advanced decline analysis and say, look at this market, because the market's grown to be complicated. There's too many tides in the marketplace right now. There's too many creative minds out there. There's too much technology in the market, and there's too many smart PhD minds that are programming systems. And there's going to come a day when the market is going to melt down. And I think at this point in time, we have to respect the fact one of two things are going to have to happen. Either we're going to see a major buying spree go on, and we're going to see a recovery in the advanced decline. But the simple study of advanced decline analysis suggests if the markets are capitalized weighted, the more stocks that go down in an individual index, and the index does not go down, that's not good. And remember, tops take a little bit longer to form than bottoms. So from a testifiable, if you're looking to trade with facts and not fiction and not opinions, what I like to say is, what kind of confirming evidence do we have in the marketplace? So going into the fourth quarter, while we have all of these wonderful seasonal trend studies in the marketplace that we've just alerted you guys to, and bear with me a second, out of all of these trends that we see in the marketplace, we may see a change of the guard, and it may not come to fruition that we see staples trend higher. I think we have to examine where will your money best be served. Now, there's a lot of people out there that are doing well in the market in options, but I definitely have to say, moving forward, options this year has been a little bit different in the sense that, I think I've gone through tracking volume trends and breadth analysis. I think we covered that. But for option trends, liquidity's become a little thinner. We see this in the bids and ask widening. Unusual volume has not been a true reliable way to ride coattails of a trade. I think trades are being built up over time and possibly being spread off or liquidated. So I think the easy money is kind of stalling a little bit. And that's what we see in this type of research and work, which is probably advanced for most people. And that's what I wanted to say. What's happening with our market? There's a lot of different, right now, you'll probably hear about it today. You'll probably hear about it tomorrow. What's going on in the market? How many people are talking about, well, the Russell's breaking down? Sure, Russell just didn't break down. It went all the way back to the lows on the July 27th time period. Can you guys see that? That's not complicated. That's pretty easy stuff right there. So the Russell, while I can't tell you we have a PPS sell signal, many of you use Thinkorswim, you can see the PPS sell signal there. It's been chopping around. Volume. This is a volume indicator. How's the volume? What trend direction is the volume? This is on balance volume. What's the trend direction of the volume? Look at the advanced decline. Advanced decline has been weakening over time. And so now if we are going to look for a buying opportunity in the market, or if there is an opportunity in the market, the first thing that we want to be looking at, numero uno, we want to be looking to see if, in fact, we hold this area of longer-term support, both not in the price of the index, not just the price or average price of the index, but we want to look at to see if the advanced decline, the number of shares of stocks, hold this level, and if, number two, the volume doesn't continue to trend weaker. If it does, then it would spell more liquidity problems in the marketplace. Liquidity in the sense that somebody is long from up here. Somebody bought the dip, and somebody bought the dip, and somebody bought the dip. And right now they're wondering, do I have much money left to hold that trade? And if it continues to weaken, it's going to weigh in on other markets that we trade. What other markets are there? The other top stock index. So it's a ripple effect. And that's where I wanted to bring to your attention that right now, looking at even the NASDAQ composite, the technology, market's going up. Looks great. Nice trend. You can see the trend is up. Doesn't take a rocket scientist to see the trend going up. But what I'm trying to share with you is what is the condition of that trend? It may be a handful of stocks, values are holding things up, whereas the rest of the smaller stuff is all trending lower. We're trading right back to where we were with the breadth of the market. When prices, think of this. Here's the advanced decline right now. Oops, bad line. And guys, we're trading when the market with that advanced decline was down on average way down here, gang. So yeah, you could look at a trend line. Is this now a breakout? So if you look at the headline news and say the Dow's breaking out to new highs and this is a great time to be in the market and the fourth quarter is the strongest one, seasonally speaking, the fourth quarter is a strong under normal years. This isn't a normal year. Something has unwound, and it's unwinding in front of us. And I'm not sure it's going to be a price-delayed reaction, but typically when the breadth of the market turns negative like this, it is not a positive for price action. So therefore, we want to be a little bit cautious. Doesn't mean to sell because we don't have sell signals. But what I would be looking for the Dow over the next couple days is that, as you can see, and I'll bring it all into picture for you. Gang, the advanced decline on 30 stocks, and that's what the advanced decline, if it's a positive day or a negative day. And the advanced decline's been kind of dancing up, and it's kind of rising, and we got the market up here, and we got this little gap. I can't say that the Dow, this is an exhaustion gap or a breakaway gap. We had a gap over here. You got a gap over there. You had a gap over here. You got a gap still down there unfilled. Here a gap, there a gap, everywhere a gap in the diamonds. So what I would say is that if we start to see a accumulation or a trend, keyword, just like the Russell, just like NASDAQ Composite, and we start to see a breakdown of the advanced decline in the diamonds. This is one that's got some ability because volume has been lackluster in this market. It has the ability to maybe enter the fourth quarter with a little relative weakness, even though it's strong. What I mean is it may be a delayed reaction. We have not seen this type of decoupling event between these indices all year. And that is what I wanted to bring into today's presentation as far as what is really happening in the world in which we trade. Volume. We've had the lifeblood of the market has always been considered volume analysis. And I know that we've helped to popularize on balance volume for many of you guys and looking at that trend. It's been a dynamic tool. There's no doubt about it. There's other ways of measuring the market. Recently in the S&P 500, and I don't know if everyone's aware of this, but in the last week, in the S&P 500, we went from 10 52-week lows to 38 in the S&P 500. If that trend continues where we start to see newer 52-week lows when the stock market is being prognosticated at new highs, that's showing internal weakness, and that's factual information. Now, McClellan Oscillator is weak. It's based on the NYSE. The NYSE is weak. But we have a relative strength analysis. This is the tool that I wanted to share with you on, which was introduced to us through, I gave out on Thinkorswim. This is the person's market catcher. And if you just bear with me a second, let me format analysis here and just turn off some things so we don't have too much going on. Because I don't want to make it complicated because there are, I think at this point in time, let's take a look here. We want to turn that one off. We're going to turn, let's see, what else do we want to turn off? I'll get rid of this. It's already turned off. Volume, I'm going to get rid of that. And let me get rid of, I will leave everything else. No, I'm going to get rid of this too. Unbalanced volume. We don't need no stinking unbalanced volume right now. That should do it. By the way, this was a small little company that didn't have very good earnings today. Many of you are familiar with Stitch Fitch. This is relative strength. This is the person market catcher. You'll find this on Thinkorswim. Excuse me. When a market makes, it just shares with us 4 stages of the market, which today is not about getting into this. This is a volume indicator we created. And as you can clearly see, looking at old highs, and everyone can see this run up in the market. Great run up and a great buy signal here, and the relative strength was looking good, and it outperformed the market. That's what bright blue shows us. But as the market starts to go up and making a new high, and the relative strength doesn't make a new high, and the volume starts to weaken and does not make a new high, and starts to show a divergence as the price was making a new high. Not hard to read. You guys can see this, I'm sure. When you start to see that relative weakness in the volume as it's making a new high, and then you get that low close doji, guess what? The relative strength disimproves, the volume's disimproving, it's no time to be long the market. So there's that relative strength is an early warning. When it starts to weaken, funds tend to exit the door relatively quickly these days and age. AMZN, let's go through Amazon, because Amazon is one of the, I mean, probably the best trades that everyone's had this year if you've been long Amazon all the way up. But, you know, what's really scary is Amazon's relative strength as high as it's been going. And I could look at the new high or the test of the high, and I would say, gee, Amazon's relative strength has weakened, and it's weakening on volume. I actually tweeted this out today, and today we formed one of those low close doji patterns. I'm going to change this over to a weekly chart. And now you would say, hey, that's kind of strange. Why is the bear with me a second. Why is the get this back into focus for you? Why is Amazon breaking out, making a newer high, and its overall relative strength is weakening against the S&P 500? Why is the volume already weakened against the market? So you've been in a weekly sell signal, and now you're in a daily sell signal on Amazon. What weight or effect does Amazon have on the overall market, right? So if Amazon, the 800-pound or 2,000-pound gorilla in the room, starts to weaken, its structural valuation is starting to weaken relative to the overall S&Ps. And that's, to me, another red flag. As go Apple, so goes the market. Apple's breaking out to the upside. Had a great week. It's in a almost a very similar chart pattern as the S&Ps. And comparing Apple to the overall S&Ps on a weekly basis, volume is starting to lose its luster up here at these highs, and the relative strength on a weekly basis is starting to lose its luster. So what is the weight of Apple against the overall stock market? Here's a daily chart, and this, my friends, is probably one of the most scariest charts in terms of relative strength. We did make a newer closing high in the market, and the relative strength against the S&Ps has weakened, and the volume structure is weakening. So I'm not suggesting to go out and short Apple this second, but I would say this little white line in the sand, we have a potential W pattern, or at least an M top pattern, excuse me. We could go up a little bit, but boy, when this thing generates a sell signal, it's under the condition that when it does trigger a sell signal, it could be monumental because of the weakening structure of its relative strength and volume analysis. It tells you to kind of pay close attention to things. I'll give you one last example. So when I tell people, hey, I'm kind of concerned, I don't have a real sell signal, but relative strength and volume, and look at things that lead up. And this is a loaded gun, I will tell you that, because we all know about Facebook. But one of the things that Facebook, as it continued to rise, as it continued to rally, it was losing its relative strength, and it was rallying with no volume relative to prior highs. Everyone can see that divergence. Price is making a newer high against prior highs. The relative strength was making lower highs, and volume was making lower highs. So taking a look at and from any point in time, you could clearly see it's got lower traditional conditions. And again, the rest is kind of history. So for me, the relative strength and the ability of funds to move mountains quickly, I would have to say, what's changed this year? A lot of things have changed this year in the marketplace, and the market is extremely vulnerable for changes. And that was what I wanted to say, hey, John, you have some tools that you created. John, you have some systems that you've developed. John, you're looking at the markets in terms a little bit differently than we used to. And that's why I look at, again, relative strength analysis in terms of percent changes. When I look at that, and lastly, let me just bring this back into focus, because this is kind of interesting. Look at the relative strength of IWM versus S&Ps. So this is the theory. I mean, I'm not saying it works every single time, but this market was breaking out, making a new high. Why was the relative strength not breaking out, making a new high, and why was there a volume divergence in the Russell? All of a sudden, the Russell versus the S&P was weakening, and when we got a sell signal, it started to collapse. So the theory is when a market rallies on weakening relative strength and divergence in volume, it doesn't tell me to sell it. It tells me to look out below. It tells me if long, tighten stops and look out. So I would say these are some of the things that are new that have been working and helping, giving us an edge in the marketplace, in the market. So we understand what makes the market. I've given you a small little look-see in relative strength, and we like to compare the performance of one market to another in terms of percent changes. And I think it's important to go down, as we like to say, what's the leadership of the market right now? Where's our opportunity in fourth quarter? And a couple things that I wanted to point out is that here's our board today. This relative strength, that's the tool that I was just sharing with you. You've probably heard about the weakness in the regional banks. Well, the regional banks just didn't start getting weak this week. Let's look at the KRE, the regional banks over time. You know, the regional banks was weakening against the market way back at the end of June up over here. It was rallying, making a newer high. That's a newer high, right? Newer high. And if it's making a newer high, why is the relative strength and why is the volume analysis, this is our volume indicator right here, why is the volume indicator making a lower high? So again, it's been a very insanely useful tool, a powerful tool. And so it doesn't give me great winning trades each and every time, but boy, I'll tell you what, if I have a sector in the market that is supposed to be strong, look at the XRT. You know, consumers are doing well, blah, 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 yada, yada, yada. Here's the weakening effect of the XRT. Look at this. The market makes a new high. What's the relative strength? And what's the volume action look like? Momentum's weakening. This is not a very good, promising picture in the XRT. Now, we have IYZ, telecoms. I wanted to focus your attention because this is a trade we're actually long the market in telecoms. It's gotten no respect. It's been dissed for years now since it broke down its relative strength and volume way over here, way over there. Made a new high, and the relative strength broke and the volume broke, right? Isn't that wild? And all this time, while the stock market's made a new high, this thing sucked air. Now all of a sudden, gang, the relative strength is outperforming the market. I don't want to say sneakier than a fart in church, but, you know, that's the old saying. So if you think about this for a second, the volume action is pretty decent. So the funny thing is we go back to our slides, and I'll just wrap this up real quick because we only got another minute. But I want to go back to this slide and say what happens in the fourth quarter. Ironically, telecoms tend to trend higher. So the sectors that do well, that have improving relative strength with improving volume action, those are the ones that will give me an edge that we might see some upside. If we're in a sector that is supposed to be strong and it's got weakening technicals, so whenever I say, hey, this has weakening technicals, I'm not talking about MACD or stochastics. I'm talking about the condition of the market, its relative strength to the overall market and its volume action. That's what I'm referencing. And so this, in this day and age, I think that's the sophistication and the computerization and the analysis that funds are using to get an edge over retail traders. These are the techniques. None of this stuff is new, but how we use it and how we classify it and how we measure it in terms of percentage, that's been, I think, modified a bit. So I think that we definitely have to understand what makes the market work, what makes the market kind of tick here. And I would like to say that for those that have access to Thinkorswim, the PMC, the person's market catcher, is a very powerful tool. I mean, this is just a case study. Look at the volume indicator. Markets, as it's moving up, it starts to do what? Show improvement with improved relative strength. It fires off, and that's the relative strength indicator. If you get a buy signal with an HCD, you have definitely an improved outlook for the market to give you a decent stock trade. By the way, this was earlier this year with, gosh, I mean, as you can see, this was literally earlier. And look at Restoration Hardware. Where this thing came from, how it got up was incredible. A PPS buy signal, by the way, this is Thinkorswim, by the way. And you can clearly see the PMC indicator and giving you good, what's the key word I wanted to say? Confirmation. That's the key word, confirmation. This is a little better look-see into the relative strength. When the relative strength is improving, it tells you, hey, you might get a little bit more out of the trade. We actually were long that trade. Now I look at this, and this is kind of a really strong picture of Goldman Sachs, by the way. Market rallies and makes a new high. True? New high compared to old high. How come it's making a new high? Why is the relative strength disimproved, in fact weakened, in fact divergent compared to its overall market? And I don't know if anyone's looked at Goldman Sachs lately, but I don't want to say Goldman Sachs, but it's Goldman Sachs. Relative strength it will help you to avoid the pitfalls of maybe, hey, if the market's breaking out, I'm going to buy the pullback. If the relative strength is weakening, buying the pullback may be a bad decision. Yeah, this was a little complicated if you've never heard of relative strength or how this tool works, but it's easy to comprehend and it's extremely efficient. And we're doing a 3-day seminar, and I wanted everyone to understand that if you have never been to one of my seminars, I think you will find from beginning to end, and talk to other people, one of the most phenomenal experiences that we've put together with some of the state-of-the-art tools and techniques. We have a closeout on our event because we are making the last and final call and closing it up because we have the caterers. We feed everyone. We have a good time. We get together, cocktail hour, and we're going to go through how to utilize not just technical tools, but the algo optimizer and go through in the 3 days from November 29th through Saturday, December 1st. And so if you are interested in learning more about me, and a lot of you know who the heck I am, if you wanted to come down to Florida, it's going to be right here in North Palm Beach. Sign up for a few golf lessons, go fishing, etc., etc. It's a beautiful time. There won't be, hopefully, hurricane threats or blown out of the water. We won't have any of those problems either. It's a lovely time down here. This is going to be an amazing time. We need your last and final call to get in so we can make sure that the caterers have our total head count. So that's number one. So we had a special, my wife Mary handles all the reservations and talks to everyone. I think there was a last and final special for the event. If you want to make sure that you're a part of an elite group of traders to use what I believe are some of the best and finest tools for retail and advanced institutional traders, sign up for this event. Go visit at personsplanet.com and you'll learn more about, or call our office directly, and I'll bring the picture into space here, guys. An incredible event, seminar under events, seminar in Florida. Without undue delay, it probably should pop up right now. No, it's not in Singapore. This was just me speaking at an event with Thinkorswim back in the day in Singapore. We just kind of looks like a really nice photo of myself. But anyway, this is what it entails, where to find the information, what we're going to be talking about, how to use and learn about statistical backtesting, structuring, how to use different momentum and mean reverting strategies. I'm really excited about this particular event, more so than anyone, because we have a lot of things that we're dealing with in the marketplace and how to become a more sophisticated trader in this day and age. So as we develop and into J-Person Asset Management, as I get into the asset management, these are the skills and the techniques that I've been using. These are the things that I've learned and taught other advanced traders, and I know you're going to have a phenomenal time with us down here in North Palm Beach. Sign up, call the office, take advantage of this seminar. This is going to be a dynamic time for any trader, especially as we will cover in one of the days. Someone had asked me, Johnny, you're going to go over the algo optimizer. And the answer is yes, absolutely. The algo 17 extreme, how do we look at that different product? We're not about talking about that today.